Hi, this is Gary Sherwold of GW Sherwold Associates. As 2016 began, pessimism about the economy has fueled Wall Street's worst start to a year in history. By the third week since the new year had begun, the Standard & Poor's 500 stock index had fallen more than 10% from a December 29th high, and the financial press was filled with dire predictions. While you could almost see the bears moving in to end the bull run on Wall Street, something about this picture did not make sense. The economy had been showing signs of strength. Four key metrics that classically herald a bear market and slumping economy were looking quite strong. The red line charts the value of the Federal Reserve's key policy instrument, the yield curve. The yield curve is the difference between the long-term bonds yield versus the short-term bonds yield. The three circles highlight times when the yield curve was inverted, when long-term yields were lower than short-term yields, and recession followed. Fed policy is not restrictive. Recessions start after the yield curve. The difference between short-term and long-term rates is inverted. The chart below shows the last three recessions since July 1983. Areas shaded in gray did not begin until the Federal Reserve inverted the yield curve. Before each recession, the Fed pushed short-term rates higher than long-term rates, leading the way toward recession. The yield curve's value in mid-January 2016 is nowhere near inversion. While past performance is not a guarantee of future results, it's reasonable to believe that we are years away from the yield curve becoming inverted. Another key metric is shown in the blue line in this chart. It measures the performance of the 10 best forward-looking economic indicators of the U.S. economy. Look at how the blue line of leading economic indicators starts plunging before a recession begins. In 2000, the blue line plunged month after month before a recession began in 2001. And in 2007, it's the same thing. The blue line representing the LEIs dropped for months in 2006 and 2007 before the onset of the Great Recession of 2008. Historically, when the LEI turns over like that, it portends a drop in stocks as well as a recession. The LEI data released on December 17th did not turn down. Stocks have been sold off despite the leading economic indicators rising fairly steadily for months. This forward-looking metric is not indicating a recession is on the way. And finally, there's this metric, which is perhaps the most important of all. The red line is the price-earnings ratio of the Standard & Poor's 500 index dating back to the end of 1988. The black line shows the price of the S&P 500 in the same time period. Earnings, the red line, drives stock prices, and when stocks are fairly priced, the black line and the red line are close together. In the tech stock crash and bear market of the turning of the millennium, the gap opened between earnings and the price of the S&P 500. There was no such valuation gap in January 2016. In fact, if earnings come as expected, the red line will pull the black line higher. No one can predict what will happen. Terrorism, natural disasters, politics, and so-called black swan events that no one could expect can become reality and change financial markets dramatically at any given moment. That's always been true, although it seems harder than ever to believe. Over long periods of time, however, we know humans make progress. We learn and make things better. In a volatile world, betting on the progress of humanity is never easy. Barring some unforeseen calamity, however, progress will slowly come to humanity in the years ahead, and the red line, earnings, will pull the black line higher. There is a lot of uncertainty and emotion that could pull the market down further, but try to keep these economic fundamentals in perspective. Please contact us with any questions or to set up a meeting, and don't hesitate to share this video with people who might benefit from my work.